If you've ever been denied for a loan and thought, I make good money, how is this possible? You're not alone. This happens to people every single day, and most of the time, banks never clearly explain why. Today, I'm going to break down exactly why banks deny loans even when income looks good, in plain English, so you understand how the system actually works. Most people believe income is the most important factor in getting approved. It makes sense. If you earn more money, you should be able to pay the loan back, right? But banks don't think the way people do. They don't lend based on logic or fairness. They lend based on risk. Banks don't ask, can this person pay? They ask, what is the probability this person won't pay? And that difference is everything. Income is only one small piece of a much larger picture. A bank could see a six-figure income and still deny the loan because income alone doesn't predict behavior. Credit history does. The first thing banks look at is your credit score. Your credit score is not a measure of how much money you make. It's a measure of how you've handled debt in the past. A high income with a low credit score tells the bank something very specific. It tells them that even though you earn money, you have missed payments before, carried high balances, or struggled with credit management. From the bank's perspective, past behavior is the best predictor of future behavior. This is why someone making $40,000 a year with a strong credit profile can be approved, while someone making $100,000 a year with poor credit can be denied. The next thing banks care about is your payment history. This is the single most important part of your credit profile. Late payments, even ones from years ago, matter more than people realize. From a bank's point of view, one missed payment is not a mistake. It's a data point. Multiple late payments form a pattern. And banks are extremely sensitive to patterns. Even if you've turned things around recently, banks still weigh your entire history. They want consistency over time, not short-term improvement. After payment history, banks look at your existing debt. This is often referred to as debt-to-income ratio, but it's deeper than that. Banks want to know how much of your income is already spoken for. Credit cards, personal loans, student loans, child support, and other obligations all count. If too much of your income is already committed, the bank sees less room for error. Even if you've never missed a payment, high debt tells the bank that adding another monthly obligation increases risk. Credit card balances are especially important here. High utilization, meaning you're using a large percentage of your available credit, signals financial stress. It doesn't matter if you pay on time every month. If your cards are near maxed out, banks see that as a warning sign. Another factor that surprises people is loan-to-value. This applies heavily to auto loans and mortgages. Loan-to-value compares how much you want to borrow against what the asset is worth. If you're trying to finance more than the car or home is worth, the bank is exposed. From their perspective, if something goes wrong and they have to take the asset back, they may lose money. When risk increases, approvals decrease, or interest rates go up. Employment stability also plays a role. Banks prefer steady, predictable income over high but inconsistent income. Someone who has worked the same job for several years looks safer than someone who just started earning more money recently. Even if your new income is higher, banks may still hesitate until it's proven stable. This is especially true for commission-based, self-employed, or seasonal income. Banks often require longer history in these situations because income can fluctuate. Here's a real-world example. Imagine two people applying for the same loan. The first person makes $100,000 a year, but has a low credit score, high credit card balances, and several recent inquiries. The second person makes $55,000 a year, but has a long credit history, low debt, and perfect payment records. From a human perspective, the first person looks stronger. From a bank's perspective, the second person is the safer bet. Banks are not trying to reward success. They are trying to minimize loss. That's why income alone rarely saves a bad application. So what can you actually do if you've been denied despite earning good money? The first step is improving payment history. Every on-time payment matters. There is no shortcut around this. Time and consistency are what rebuild trust with lenders. The second step is lowering credit card balances. Keeping balances under 30% of your available credit dramatically improves how banks view your profile. Next, avoid applying for multiple loans or credit cards in a short period of time. Each application creates a hard inquiry, and too many inquiries signal desperation or financial instability. Building longer credit history also helps. Older accounts show experience and responsibility. Closing old accounts can actually hurt more than it helps. Finally, understand that banks don't see everything. They don't see cash savings unless it's part of the application. They don't see future plans or intentions. They only see numbers, patterns, and probability. Once you understand this, loan denials feel less personal. They're not judgments. They're calculations. The good news is that calculations can change. Credit profiles improve with time, discipline, and strategy. If you understand how banks think, you can work with the system instead of against it. If this explanation helped you understand why loan denials happen even with good income, subscribe to the channel. Here, money is explained simply, so you can make smarter decisions before signing anything.